Morning, everyone, and welcome. I'm Nikki Motin, CPA and founder of Andorra Consulting. Today, we are going to talk about the financial systems you need before growing your construction business. Growth sounds good. More jobs, more crews, bigger projects, more revenue. But in construction, growth also brings more material costs, more subcontractors bill, and more cash pressure. So before you grow, your numbers need to be ready. Today, I will walk you through the key financial system you need so growth creates more profit, not more stress. Let's dive into it. So grow, what is the grow? The financial system, grow is the financial capacity decision, which means more jobs, create more jobs, more crew, more project, and bigger contract. We create more costs. Payroll, material, subcontractors, trucks, equipment, and admin load. More costs create more cash pressure, which means money go out before it come back in. And that means more risk. So the question that we always advise our customer we work with to ask is, can my business financially support the growth I want? If you cannot answer this question, it means that the goal is not just to get bigger. The goal is in that your goal is that you are not ready for the growth, because the goal is not to make you bigger. It's also to grow without losing control on your profit and cash. So there's something that we call the growth track. What is the growth track? That means more revenue can still mean less control. So I have created two scenarios here. So you have two business models. Your current business model and the fast growth business model. Let's look first the current business model. We have a core revenue of 1 million. So this 1 million, we create 28% gross margin, which means that the gross profit is $280,000. And then we apply the overhead that is $210,000. We stay with the net profit of $70,000. What is that fee on cash? A fee that cash is manageable. You are in the comfort zone. You are not in the, but you can manage your cash. You are not in the comfort, but you can manage your cash. And let's look at the scenario for someone that is going fast. They double the revenue, $2 million. And the gross margin is 18%. If you have a gross margin 80%, that is the red flag. So that is why you see here, I have it as a red. And the gross profit, we have more, if you look in terms of numbers, right? So the gross profit is $360,000. Okay, so $360,000. The gross profit, if you look at the gross profit is a little up. Before it was $280,000. But look at the gross margin. The gross margin for the $360,000 is less than 20%. And now let's look the overhead. The overhead costs have increased by half. So you have more overhead costs, which leave you with a net profit of $30,000. With a net profit of $30,000, put you in the cash stress. So the cash is tight. So that means you is stressed regarding cash. So what I'm trying to say here is that the revenue went up, but the margin has dropped. The overhead increased. So because the overhead increased by half, then you cannot control your margin is, your net profits have dropped. You have dropped. So, and this is what I'm trying to demonstrate here with using these two models. What I always advise my customer is that grow with that is that you have to grow with a system, because grow with that a system can make the business bigger. They can make the business bigger. That's true. You went for 1 million to 2 million, but you are weaker. You see the net profit is is $40,000 less of the one from 1 million. So these two scenarios is just to demonstrate that before you grow, you have to look everything. So growth is not, it doesn't mean that you are successful. It might mean more stress if you are not ready to grow. So this is the system that we put in place when we work with our customer. So we always recommend our customer to have this system in place. We will help you implement this system. All our customer have this system in place. We help them implement it. So what is the system? The first one is what? Or the system is the clean books. You have to have a clean books. You have to have a job costing set up in place. That is the second part of the system. And then what is the third part? The cash flow. You should be able to manage your cash flow. We always recommend to have a cash flow forecast. So we will create a cash flow forecast for you when we see the movement. That will help us see the movement of the money and when the money will come in. So the prediction. And then we also, the 4-1 is the billing and collection system. You have to have a billing and collection system in place. You cannot just create an invoice and just sit there and wait for the customer to decide when he will pay. You have to follow up. And then we also make sure that before you price your job, your overhead cost is built into your prices. If your overhead cost is not built into it, then there is a problem. That means your pricing will not, your contract that you will win will not cover all the costs. And then we recommend the monthly CFO review. So we always have a monthly review with our customer where we walk them through everything so they can see the big picture. They can see where they are going before they even take all the decisions. Okay, so before you grow, this is the question we always advise our customer to ask themselves. Are we profitable by job? If you cannot answer this question, it means that your system has a problem. Because you should be able to see how much you are making per job, not the overall job, but per job. And that will help you to see which job is draining the money or is eating the margin of the other job. And the second question is that, do we have a cash to carry growth? So do we have it? This question you should be able to answer it if you have a better system in place. That is where the cash flow forecast comes in. Because if you don't have a cash flow forecast you won't see that, you won't have that better visibility of your cash. Then that will see what that will give the answer of the question, help you. So we tell me that you have a visibility of your cash. you have implemented your cash flow forecast, and you can see in 13th week cash flow forecast. That is what we recommend, how you can fund the payroll, how you can pay material, how you can even pay some contractor before you receive payment for the customer. If this you cannot answer this, there's a problem. And then what I was talking about the pricing, does the pricing cover the overhead? Your job pricing should include your overhead costs. Your overhead costs should be built into your job pricing. When you price your job, you should make sure that all the payroll, all the office payroll, insurance, vehicle, software, whatever you have, or even your proper pay is included in your job, in your contract, in the contract of the job, so on the prices. And then this 4 question that matter here is, can we review the business monthly? Because when you review, if you cannot answer this question, that means you are missing something. Because when you review your business monthly, then you understand where your business is going. You have a better visibility of your business, and you can make make decision on the right numbers. Okay, so let's talk about the first system that I described before on my I'm sorry. Let's talk about the first system. So when I was demonstrated, this is the clean book. Yes, the first system is the clean book, because the clean book is the foundation of your financial system. So what is it? This is the checklist that you have to answer. So I have a statute for yes or no. When you leave this life today, go and ask yourself, can the bank reconciliation is reconciled? If you say no, then there's a problem. You should have a yes here. Everything here should be a yes for you to know that you have a better system. If your credit card is not reconciled monthly, your bank is not reconciled monthly, your loan does not match your balance sheet, then you have a problem. The other one is the payroll recorded correctly. When I say the payroll should be recorded correctly, because I have seen this a lot. Some of the payroll some of the charging on the gross payroll, the gross wage, most of the time I will see the net pay that is coded as a gross wage. This is the problem. The net pay cannot be the gross wages. That is why I'm saying here that you have to make sure the payroll is recorded correctly, because if it's not recorded correctly, then your number is wrong. And then I also seeing the owner draw count as included in the job costing, and that they're counted as expenses. This is wrong. Your draw cannot be an expense for the business. So that has to be separated, not coded to the job. And then the income. Do we record the income in the correct period? Is it recorded in the right period? If it's not recorded in the right period, you won't know. You will not know the exact how your business is, where your business is going. So everything should be recorded in the correct period. If it's not, then you have to review your books and make sure that everything line up with the accounting period. And then the expenses per job have to be coded to the correct job. If you have the job system in place and you do not code it, and your coding is wrong, then your job profitability will be wrong, and you will make decision based on the wrong number. So this have to be taken care of. That is why this is the checklist that I have created. If you want this checklist, just put the comment below. Checklist, clean bookkeeping, check. and I will send this to you so you can go and look and mark everything. So you look at the book, and then if you can mark yes on this one, then you have a strong system, you have a clean book system in place. If you cannot, if one of this is wrong, then you have to fix it to be able to say, yes, my books are clean, because clean books is the foundation. So like you can see here, my point is that you cannot use missing books to make a clear decision. If your books are wrong, your reports are wrong. If your reports are wrong, then your growth decision is built on weak numbers. So you have to make a better decision growth, your book has to be clean. Okay, so let's see how the transaction, the clean book turn the transaction into a decision. You have transaction will come for bank fee, receipt, bills, or payroll, and you'll receive the transaction. If the transaction is coded correctly, then you do the categorization of those transactions. And then the second part is that you reconcile your books. So when you reconcile your book, you match the account to the reality. So your account meet the reality by reconciling your books. And then you will produce, after the book are reconciled, then you will produce your financial reports. So your financial reports here is your P&L, your balance sheet, your AR aging report, your AP aging report, and with all this together, I forget. You also have to include the cash flow forecasts on this financial report. That will help you when everything is put together. Then that will give you the growth decision. So if every transaction is good, your books are clean, then your possibility for you to make a growth decision is high. So what is the growth decision? When we say growth decisions, we are talking about hiring in the right time, the right person in the right place in the right time, and also the pricings. When do you the pricing? How can you price your job, and when can you buy equipment? When can you take more job in your plate? So we always say, if your input is weak, what is weak mean? It means that you have a reconciled account, you are missing some costs, and then you mix owner draw with expenses. Then the result is a weak input. And if your input are weak, then the possibility for you to make a weak decisions is high, and you will find yourself in the financial stress most of the time. Okay, so let's talk about the system number 2. The system number 2, that is the job profitability. So your job profitability you should be able to tell which job is making money and which one is not, which one is eating the profit for other job. I have this is an example that I pulled from one of my customers. We have the remodel. We have job remodel A, and then we have the customer B. We have the roofing job C. So if you look very closely on the prices, you will see that we have $85,000 for remodel A. We have $250,000 for custom build, and then we have the roofing job C, which is $42,000 contract prices. I remember when this customer, when this customer received the $250,000 job, he was very happy because for him, he thought that he will make more money. But if you look at the reality, it's not the case, right? So the more you see that the $250,000 job is giving him only 14% of gross margin. That means he won't be able to cover the allocation, the overhead allocation that will be assigned to the job. And you can see that this job will eat the margin of the Romolo one and the Rufi one. So if you see the Romolo we have, for the Romolo we have 27% gross margin, which is, that is a healthy job. And the job number C, the roofing, is 25%. So to be in the comfort, I would say if you grow with, you look your job costing and your gross margin your gross margin for the job is less than 20%, that means there's a problem. So normally your gross margin for each job should be at least 20% for you to be in the comfort zone or the manageable zone. If it's less, then the possibility that you feel tight in cash will be high. So, this is the question we always ask, like, which job should we repeat or fix or stop taking? Based on this one, you can tell which job you can stop taking, or you can fix, or which job you can repeat based on this model, right? Because if you are having a $215,000 job and you end up with 14% margin, there's a problem. You have to review your prices on this one, or you don't take it at all. Okay, so when we talk about job costing, what go inside the job costing? What go inside the job costing is the labor. When we talk about labor, we talk about the crew salary, the crew salary, because those are the salary that is directly tied to the job, because they are working on the job. So when you pay them because they are working on the job, they do not have any other tax that they have to do. They're assigned for the job, they're working for the job. So whenever earning they have for the job is a direct expenses for you. And we talk about material. So you are buying the lumber, fixer, or other supplies. This is tied to the job because you need this material to perform this job. If you don't have the material, you cannot perform the job. Those are the costs that go under each job when we talk about job costing. These are the one. We have the subcontractor. You will hire an electrician to come and do the electrician for the job, or the plumber, or the concrete subcontractor. So that is why it's directly tied to the job. When we talk about job costing, we are seeing this cost first: the permit, the equipment, the rental equipment. You rent the equipment, you buy fuel for the equipment. Those are the cost that is directly tied to the job, or whatever rent, it's more tool you rent. And the dumpsters is also tied to the job. The change order tied to the job. If the customer change the order while the job is in progress, then you have to review the expenses that occur for the change order. We go directly to the job. It's not going to be a separate job costing anyway, so it will go there. And financing, we are talking about the interest. If you take loan to perform this particular job, the interest you are paying for this loan is tied to the job. Because of this loan, because of the job, you took that loan. So all the costs for that loan is tied to the job. So that has to be charged to the job. So what is the job costing is how you find the differences between a busy job and a profitable one. So you might have a job that is busy, but it's not profitable, like the $250,000 job that we have there. And that job was very big based on what for what I see for my customer. That job was really, it was a busy job, but it wasn't profitable, right? It required more attention, but it wasn't profitable at all. And this job costing help you identify which job is profitable, which one is not. Okay, let's talk about the third system. So the third system, we are talking about the cash flow forecasting. For example, we always know, I always say here that profit is not the same as cash. So your profit is not your cash. Your cash is what you have in the bank, and the profit is what your accounting system is telling you. Profit problem. What is the profit problem? The profit problem, we will identify the job that were on the prices, and we will identify the labor that was over budget. So if you budget the labor for 1,000 for this particular job, and you end up paying 2,000 or $1,500, that means you overpay on this job, you overpay the labor on that job. And you can see the missing cost, the cost that was coded to your own job instead of the one that you are looking at. And then if you have the margin that is too low, that is the profit problem. If the margin is too low, then you are facing profit problem. And sometimes we will see the overhead not priced in. Like I was saying, your job costing, your job price should have the overhead cost built in. If the overhead cost is not built into that job price, then the possibility that you are losing money is higher. Now let's talk about the cash flow problem. The cash flow problem is that it doesn't have anything to do with the pricing, with the labor or whatever. So we are talking about the customer that pay late. We are talking about the material that get paid upfront. We are talking about the retainer that will held back from the owner of the project. We are talking about the payroll that is due before you even before your first draw arrive. And we are talking about the vendor bills that is due before the collection. So those are the cash flow problem I have listed here. So if you want this list, you can just comment there cash flow, and I will send you cash flow problem, and I will send you that. So let's go to let's dive into the cash flow forecast. I have a little table here that I prepared for you to show you how the cash flow forecast works. So I split into 2 weeks. So I'm showing you just 2 weeks, but normally this cash flow go up to 13 weeks. 13 weeks. So we start the first week we start with $45,000, and then we are expecting the cash coming in at we are expecting $25,000 cash inflow cash, and what we're gonna spend is $38,000. So if you see at the end, we will have $32,000 cash at the end. So we start with 45, we are expecting 25, and we expected paying 38 in week 1, and the end cash will be 32. Now let's go to week 2. Week 2, we start with $32,000. The cash in that we are expecting is $15,000. But guess what? We're gonna spend on this week $42,000 cash. So what will be left is $5,000. So we are in the red position, right? So the cash will fit tight on week 2, right? And then we start week 3 with $5,000, but we are expecting $60,000 cash. And then we're gonna pay $35,000 cash, and we will stay with $30,000 cash. So when you have this visibility, you know that in week 2, the possibility that you run out of cash is higher. So you also have to make sure that you collect as much as possible of the money. You are expecting money coming in. And if you are looking closely on your receivable, this is the time for you to, the receivable that is past due, this is the time for you to follow up. Make sure that you can receive more money that week for you to be able to pay that $42,000. So this is what we always recommend our customer to have the cash forecast. We always implement this. You can add the column here between the expected inflow and call that the date. So the date, you can have the date between the expected inflow and the expected outflow, and then you can have another date on the expected outflow and the cash. And this one, when are you going to pay that $38,000? You can have the date for the payment or in the date for the inflow. So you can add the date there, or you may not, but for having this is already something that help you to have a visibility of your cash. And you have a little chart here that I put to so you can visualize it. So you go for 38K ending balance on week 1 to to 5K ending balance on week 2. You can see that week 2 is a problem, and you have to be prepared to that. And then let's talk about the system number 4. Like I was saying here, we know that week 2 is a problem. Then if you have the billing system, the billing collection system in place, then you will have, and you can make that turn into cash quicker. For example, what is the billing system? The work is completed. If the work is completed, the field work finished and milestone reached, then what do you have to be doing next? Next, you will send the invoice out. And the third one is, what you have to do is follow up on the invoices. So review your aging report. Your aging report will help you to know which invoice is outstanding, which customer to contact for this in particular invoice, and then you have the collection payment. So if you don't have this system in place, how do you know that your invoice is still pending? How do you know that the job that was completed, that your invoice was sent out for the job that was completed? So if you have this system in place for the for the billing process, then the possibility for you to follow each step is higher. The possibility for you to collect your money faster is higher. Because if you have late payment, you have a huge aging report that you are ignoring, then the possibility for you to fit tight in cash is high, and you can face cash flow problem. So like I say here, revenue is not cash until it's collected. So you see you have that $2 million revenue. Is it collected? No, if it's not collected, it's not cash, so it has to be collected. Okay, so I went deeper to show you how the aging is showing faster, so how you can use the aging to collect cash faster. And we have customer A, we have customer B, customer C, and customer D. So each client have the money that they are owing, right? And you can see the outstanding day. So if you see 64-day outstanding or 90-day plus outstanding, then 64, you have to call. That is the urgent call. If it's over 90, then you have to propose the payment plan and review, right? 38 day, you have to follow up. And 15 days, this is the way you start a monitor, right? So I have put here the amount that each customer is owing, the outstanding day, and then the action that needed to be done. So this is how we manage the aging report for our customer every week, every month, and we have to review it with the customer every month. So like I said here down here, a CFO doesn't just look at the sale. A CFO watch how fast the business turns sale into cash, right? So if you unable to turn your cash faster, then there's an action that need to be taken. And by monitoring your AR aging, by monitoring the AR aging, that is you also set it up the action of the payment, the action and follow up for the payment. Okay, so let's talk about system number 5, overhead. I will say overhead must be built into prices. I have listed here some overhead. This is the example that we have from our customers. So we have payroll 8,000, insurance 3,500, truck a fuel 4,200, software to be short, we have a total monthly overhead of 22,600. So this 22,600 should be built into the job. So the overhead, we also have to remember that overhead is it doesn't belong to one job. It belongs to all the jobs that you are working on. That is why we always recommend to have an overhead allocation. So if you build your overhead allocation table, every time you change the job, you come and you plug in those prices, the contract prices, then that will give you the overhead percentage that should be applied for each job. This is how that also help you, to price the job. When you price a job and you have that overhead allocation table, you just plug in the contract price that will give you the percentage of the overhead that have to be into that particular job before you prices. Okay. So yep, we recommend that. And let's do the price reality check. For example, we have the job price is 100, and then you have a direct cost, $75,000. The gross profit here is 25, which is $25,000, which is 25% gross margin. And then we have the overhead share. The overhead for this particular job is $15,000. So the real profit is $10,000. So you can see that the price, let's look the price of the job, right? So we have the price of the job is higher, and we can see always the direct cost is the direct cost is the direct cost is the one that will be higher for all those for those costs. If the overhead is higher than the direct cost, that means there's a problem. And you have the overhead share that is $15,000, and you really profit. So the owner may think that the job, sometimes the owner, when they don't, when the norm, sometimes they don't even apply the overhead, and then we say, oh, I make 25% of this particular job, but it's wrong. You did not make 25%, you did not make $25,000. The $25,000 is just the gross profit, that is the job pricing minus the direct cost for the job. Now, what is the where does what how much do you spend? How much overhead do you spend for this particular job? So once you apply the overhead for this particular job, then you should be able to say, okay, my real profits is $10,000 for that, like this one. Okay, let's talk about the system number six. Number six, we are talking about tax planning. Yes, tax planning should be part of your growth, right? So the first one is the tax reserve. Always set aside in cash during the year. Don't wait until the tax season to look for the cash that you will use to pay your tax liability. You have to have a tax reserve in place that you put in place to pay taxes. And then the second one that we also recommend is to make the estimate payment. So making estimate payment will save you to pay surprise penalty, to pay penalty on the taxes. And then the equipment, you have to plan for the equipment. You don't just go ahead and buy the equipment because you want to save in taxes. Before you buy the equipment, you want to make sure that it doesn't hurt your cash. So these have to be planned before you execute it. And then the accounting method, which accounting method that have to be used for you to save in taxes, to understand when the revenue have to be recorded and how it can affect your taxable income. So those are the strategy that we use with our customer to make sure that at the same time they save in taxes, they also make estimate payment to avoid penalty, pay money for nothing. The system number 7, we talk about the monthly CFO review. So how we help our customer to turn number into decision. We first look the revenue, and then we look the gross profit, and we look the gross margin. So to see if the price of the job was reasonable enough. Like I was saying, if you have a gross margin 20, at least 20%, that means your prices were reasonable. If it's less than 20%, there's a problem. There's a problem. And then we look the net profit and look the cash balance. We discuss about the cash balance. We discuss about the aging report. We discuss about the AR aging report. We discuss about the AP aging report. And then we discuss about the tax saving, and then and the payment and debt payment as well, because that is part of the cash flow obligation. So these are the points that we review, that we discuss during our monthly CFO review with our customer. So the goal is not just to read the report, the goal is to decide what to do next. And when we review these numbers, we also see the strategy that have to be taken to, for the good of the business, to make the business grow. So yeah, this is your monthly review CFO, and that I have shared, our monthly review CFO that we do our customer, that I'm sharing with you. You can do it, or you can reach out to us, and we will be happy to help you. And then we also have something that we call the growth richness scorecard. This is very important for you to rate your system. So you can rate each system after you do that little exercise that I have given you earlier. How far you can rate your clean book, how far you can rate your job costing, your cash flow forecasting, your billing collection, your overhead costing, your overhead cost and prices, your tax planning, and your CFO review, right? So I have put some score here. I said if it's between 2, if it's 2 to 1 to 2, so that may going for you will create more problem than than a solution. And if you if the score is 3, then it means that your foundation, the foundation exists, but it needs to be straightened. And if you are between 5, if you are 5 to between 4 and 5, and that means you are in a better position to make a good decision. But like I said, you can use this and to rate your system. If you want me to send this one, just call a scorecard, you just comment and say Grow Regional Scorecard, and I will send it to you with how it works. Thank you. And what is the CFO score should tell you, like I was saying, the red pose the grow, the yellow mean that you should be careful to grow carefully. Grow carefully, don't grow, without a direction. Some system exists, but it's not, you have to look at it. And the green one, that means you can grow with control. So if you are in the green bottom, the green face here, that means you can grow with control. But if you're here, you have the yellow, you have to take some step. And red, don't even think about growth. Okay, so if you are not sure, if you are not sure that your number are ready for the growth, Andorra is here to help you clean up your number, understand your job profitability, improve your cash flow, and build a financial system before you scale. So if you think you still have some question and you still need some clarity on your books, just book a free business financial strategy call with us. We'll be happy to jump in and help you and implement the system that you need to grow. So always remember, more job are not the goal by itself, but the goal is profitable. The goal is number, system, and control. So thank you for joining me today for today's live, and I was happy to share this strategy with you. So feel free to reach out. You can put a comment, your question. I'll be happy to jump in and answer the question. Okay, so thank you, and let's talk again next week. Thank you. Bye-bye.